Hello and welcome to the first in a series of bi-monthly webinars focused on transfer pricing presented by Grant Thornton. My name is Jason Cassis and I'm a transfer pricing partner with Grant Thornton in Australia. And I lead the Grant Thornton transfer pricing team in Asia. This first webinar focuses on the impact of transfer pricing on customs and vice versa. Today's webinar will focus on the Australia-India trade corridor. The concepts, though, and issues are applicable to trade throughout the region. We might move to the next slide. We're excited to be hearing from two experts. Fatima Hanaid is a transfer pricing expert based in Bangalore, India, with over 20 years experience. She is recognized as one of the leaders of tax in India. Joining her is Richard Nutt, who is a trade and customs partner in Grant Thornton, Australia. Richard works with companies to reduce costs and risks within their supply chain through operational improvements. Now, a bit of housekeeping before we get going. All microphones have been muted and cameras have been turned off. However, please feel free to ask questions throughout the presentation by typing in the Q&A box at the bottom of your screen. Our presenters will attempt to answer your questions during the presentation. However, we have also left time at the end for questions. Also, a warning to be prepared. There will be a couple of polling questions throughout the presentation that we would really appreciate your responses on. This webinar comes hot on the heels of a 3-day visit to Australia by the Indian Prime Minister, Mr. Modi, which at times looked more like a stadium tour by a global recording star, with the Australian Prime Minister, Mr. Albanese, even likening Mr. Modi to American rock superstar Bruce Springsteen. This is the 6th time the two leaders have met over the last year. And it certainly seems they have a strong desire for a deeper relationship. And this is being evidenced by last year's Australia-India Economic Cooperation and Trade Agreement, by the Migration and Mobility Partnership Agreement, the Renewable Energy Partnership, as well as the imminent Comprehensive Economic Cooperation Agreement. Now, we really appreciate your attendance on this webinar, and I'm now going to hand over to today's presenters to talk you through the trade implications of this important relationship. Thanks, Fatima.
Thank you so much, Jason, for that overview. And I'm particularly excited about the announcement that Australia proposes to open its 5th consulate in India, located in Bangalore, where I am located. Coming back to our slides, and before we jump into talking about the interplay between transfer pricing and customs, I think it'll be useful for us to do a quick sense check of how important really transfer pricing and customs is in today's global trade. So let's have the first polling question, please. What percentage of the global trade is conducted amongst multinational corporations? 3 choices: more than 80%, more than 30%, more than 60%. It's very interesting, Richard, how it's moving. Well, you got it right. It is more than 60% as per the statistics published by the World Trade Organization and UNTAD. The volume of transactions amongst group companies in international trade is more than 60%. But those of you who answered more than 80% are also not wrong, because the global value chains impacted by these multinational corporation intra-group transactions actually aggregates the volume to more than 80%. So what is transfer pricing? Transfer pricing is the price that multinational group companies charge each other for transfer of goods, services, intangibles, financial transactions, etc. And it directly impacts the income tax that is paid by the transacting group companies in their respective countries, but also directly impacts the amount of customs duties that the group companies pay in the respective countries. So as you can see, while the focus of customs is on price, the focus of income tax, although it comes out from the price of group company transactions, the focus really is on the income tax. Because of these opposing requirements of both these regulations to get the fair share of customs duties, but also get a fair share of the income tax in their own country, it results in a tug of war on the price of the goods and services. But let's remember that it's the same transaction that we are talking about. So this tug of war between customs and transfer pricing actually results in a lot of hassle and challenges in maintaining the price, which is acceptable to both customs as well as transfer pricing. And the complexity increases even more when the prices are not accepted by either of the two authorities. In a bilateral trade, I refer to it as the four-dimensional or 4D effect. Let's remove the poll question from here right now. Essentially, it impinges on the ease of doing business. Moving on, transfer pricing regulations are incorporated in the income tax laws of various countries worldwide. And while the framework in domestic tax laws could be minimal, there's a lot of guidance available in the OECD transfer pricing guidelines, are extensively referred to by companies as well as countries and administrative authorities, of course, as it suits the case, but extensively referred to by them. The UN transfer pricing guidelines are also available in content a lot similar to the OECD guidelines, but more addressing the needs of developing countries. The transfer pricing regulations embedded in the income tax law seek to ensure one predominant objective, which is that the price in intercompany transactions is computed similar to what independent parties would have agreed to and referred to as the arm's length principle or the arm's length standard. In order to help MNCs calculate a price which adheres to the arm's length standard, transfer pricing methods are often prescribed in the law itself. The Indian transfer pricing regulations prescribe 6 methods. The comparable price method, which looks at the price charged in the transfer of goods or services. Resale price method is another method, but only applicable in buy-sell situations where a company purchases from a related party but sells to third party, and the focus here moves from price to the gross margin level. The cost plus method is often used in contract manufacturing risk mitigated situations and works on the direct and indirect cost of production along with an arm's length gross margin. So here also the focus is on the gross margin. The next method, the profit split method, seeks to actually allocate the price in the overall transaction between the related parties involved. It's a little complex and it's based on some economic valid basis for allocating the profit margin between the transacting companies. The next method, transactional net margin method, relies on the net margin realized from the operations, the services that are undertaken by the group company, whether it's manufacturing, it's a captive service provider, R&D, it can be any of those operations. And lastly, there is a sixth method, often referred to as a residual method, which comes in when none of the other methods are applicable, such as in the case of valuation of shares, where the value is derived based on certain assumptions and benchmarks. And maybe this is the right time for us to have a quick check on what do you think is the most commonly used method in order to determine the arm's length price for transfer pricing under income tax regulations. Let's have the next poll question, please. Which is the most popular transfer pricing method? TNMM, transactional net margin method, cost plus method, residual method. %63 are going with TNMM, 30% are going with cost plus, and 8% with residual method. All right, this is very interesting. I often get results like this. The most commonly used method is TNMM. And I believe once the people who answered cost plus method also realize that the way the TNMM method is implemented is actually known to you as cost plus method, but since it includes all the costs, direct, indirect cost, overheads, and an arm's length margin, it at times ends up being the transactional net margin method. So from here on, let's move over and have a view of the customs policy landscape. Richard, over to you.
Yes, thanks very much, Fatima, and good afternoon to you all. Over the next few slides, I'm going to provide some insights into the principles of customs valuation. But before doing that, I'd like to do a quick poll question to test people's knowledge of the customs landscape. So could we have the poll question, please? Okay, so there's three options here. Which is the most popular method under customs regulations with tax authorities and taxpayers? Is it the deducted method, fallback method, or the transactional value method? Do you want to see the results now? The correct answer is a transactional value method. Speaking with Australian Customs just a couple of weeks ago when I was in our offices for a meeting, about 80% of transactions reported into the customs portal is the transactional value method, which I suspect is relative to the transactional net margin method from a transfer pricing perspective. So look, the policy and framework for valuing goods from a customs perspective is built on the framework of the Article 7 of the General Agreement of Tariff and Trades of 1994. This has since been superseded by the World Customs Organization's guidance, and also then you've got to factor in the domestic customs regulations in either India, Australia, New Zealand, or in the US or the EU. So as with transfer pricing, there's probably there are 6 methodologies you need to consider when you're valuing your goods from a customs perspective. But first of all, you've got to remember there is a hierarchical approach to valuing goods. And the first method you've got to look at is what they call the transactional value method. And you've got to see if the goods that you're importing in the transaction actually fits into the method 1. If it does, you can't actually decide to move to methods 2, 3, 4, 5, or 6. So the transactional value is the most obvious one. It's the price paid for the goods. So price paid for the goods, for that to be used, you've got to have a sales transaction that is a purchase order raised at the time the goods were exported from the particular country. This condition actually applies to methods 2 and method 3. So method 2 is the identical goods. This is when the goods have been shipped with the same physical characteristics from the same origin and the quality as the goods being imported. The third method is a similar goods, which looks at the goods that resemble the goods being imported from the same origin and technical specifications. As I say, before you can move to methods 2 or 3, you got to look at the reasons why you can't use method 1. Hence the reason why 80% of transactions reported into customs by the transactional method, because typically there is the evidence of a sales transaction at the time of export. There is a caveat around this, what we need to consider. If I was using the Incoterm DDP, DDP, the flash title of the goods, the sale actually only takes place when the goods are delivered into the store. If you work on the true spirit of what the DDP Incoterm means. So if we can't use methods 1, 2, or 3, because there's no sale transaction, we then got to look at methods 4, which is a deducted methodology. Now, this determines the customs value based on the resale price of the goods in a country, i.e. Australia, minus any deductions. Now, the condition for being able to use this is the imported stock typically needs to be sold within a 90 days period from when it was imported into the country. If you can't meet that condition, you're excluded from using method 4. Then you got to move to method 5, which is a computed method. This looks at the cost buildup of the imported goods. Again, I've been using this for a couple of clients in some instances. And then the last method is method 6. This is the fallback method. So this allows a degree of flexibility to be applied to methods 1 to 5 in order to determine the customs value. The other interesting one when customs valuation is when you're doing a stock transfer. And that could be where I'm sending goods from, say, Australia across to, say, our close counterparts in New Zealand. There is no sales transaction when there's a stock transfer. So how the goods are treated. So obviously, as I mentioned, in methods 1, 2, or 3 cannot be used because there's no sale transaction. If it's slow moving inventory in there, it rules you out method 4. And then you might need to consider method 5, the computed method. So depending on your supply chain activity, you've got to consider the impacts of different variables within your supply chain, i.e. stock transfers and that type of stuff. Because obviously this has got customs implications as well. So with that, could I move to the next slide, please? So look, I've talked about the methodologies and the principles of valuing goods. So look, first and foremost, the declared value for custom valuation purposes, the free on board value, which is typically known as the FOB value from an Incoterm perspective. So what needs to be included in the custom value? Well, if it's price paid for the goods, so it's a sales transaction, you would expect it's going to capture any production assist costs. And so what do these look like? So I'll give you an example of one. And one scenario which sometimes is a bit of an issue with some industry sectors. So if I source goods from Italy, we're imported into India, and those goods are sourced at a cheaper price than what the market value price should be. You've got to actually factor in the production assist cost at the market value, not the reduced cost. The implications of doing that is that you could be undervaluing the assist costs from a customs perspective. You got to capture the overseas freight from the point the container was actually packed, not from the place of export, the port of export. You got to factor in packaging costs. So if you've got some particular cargo that needs additional packaging, that's got to be factored into the customs value. You've then got to include commissions and royalties and license fees. Very high level, pretty obvious. And obviously this is simple methodologies. That's what you're going to derive from your transfer pricing valuation as well. So could I go to the next slide, please? So look, we've talked about stuff about the valuation of goods pre-arrival. So we've also got to consider post-importation adjustments as well. So as Fatima mentioned, you've got the transactional net margin method. When you're using this methodology from a customer's perspective, depending on the profitability of the company in that particular country and the targeted profit margins and the transfer pricing policy, it might result in post-importation adjustments due to transfer pricing adjustments. So if it's a true up, that results in a debit note being issued, which increases the customs value. If it's a true down, it results in a credit note being issued, which reduces the customs value. Again, there is an obligation in the Customs Act to make these disclosures. In Australia, it's a 4-year mandatory period. Failure to do so could result in penalties. It's important you do this anyway, because you might even get a customs duty refund, reduction of GST. Conversely, if it's a debit note, it's going to be an amount payable situation where you're potentially paying additional customs duty and GST. The last post-importation adjustment is typically around royalty and license fee payments. So any payments made post-importation in around royalties potentially needs to be disclosed to customs. However, there is some conditions what you need to consider when disclosing a royalty post-importation is. It only needs to be considered into the customs value if it was a condition of sale at the time of export and it wasn't included in the price paid for the goods at the time of importation. The buyer must pay the royalty or license fee either directly, indirectly, and again, I stress it's got to be a condition of sale. An example of this is if you have a license agreement which stipulates that the seller cannot sell the goods to the buyer without paying any royalties or license fee, this is actually a condition of sale. So on that basis, even if it's made embedded into the customs value upon importation, or if it's made post importation, it's likely you're going to have to make a disclosure to customs. Again, because there's going to be potential customs duty and GST implications there. Just on that point, before I head into some case studies, does anybody have any question and answers they want to push through?
And Richard, while we wait for the questions, I'd also like to share with the audience some of the nuances while applying the transactional net margin method, if that's fine.
Yes, no, that's fine, Fatima.
So I'm just going to take the slide back to this one, where, we talked about the fact that transactional net margin method tends to be the most popular method. And here are some of the key considerations one would like to keep in mind while going about using the method. And these often come up during transfer pricing audits as well. The first one is free of cost assets. Now, it's very commonplace to expect that one group company may share assets on loan basis, for example, for R&D or just computers or servers, or even licenses which are procured globally but provided for the global workforce. These kind of transactions also need to be included, and an arm's length share of the usage of those assets needs to be factored in the cost as well. The second one being the foreign exchange differences, whether it's loss or gain, often is considered operating, which means while calculating your net profit margin that group company is earning from intercompany transactions, these need to be included in the profit level indicator calculations. The next one being the head office charges. Very often MNCs have corporate structures which govern the group companies worldwide and often allocate these costs to different group companies. But one of the most litigated aspect about head office cross charges tends to be what is the quantum and what is the benefit that the individual legal entity has derived from these head office cross charges, right? And if the documentation is not sufficient, or if the benefit to the local legal entity is not demonstrated adequately, they even determine nil value for these cross charges, resulting in a lot of litigation. The next one is that while calculating the net margin, non-operating income as well as expenditure, such as profit or loss on sale of investments, profit or loss on sale of assets, extraordinary income or expenditure, all these are removed particularly where local entities have transactions with, have an independent domestic business, and they also have a business with group companies. These two need to be segmented, and costs and income not relating to the group company transactions needs to be removed. Lastly, accounts receivable. Although this does not go into the arm's length price determination of goods and services, it's a very important angle that needs to be handled very well. While companies need to make sure that their receivables are contained within industry acceptable norms and are not managed just for cash pooling purposes within the MNCs. If this is not done appropriately, the tax authorities often add a notional interest based on the interest rates prevailing in the country. So this kind of just caps off some of the key points that I had in mind for applying the TNMM method. Richard, with that, let's go ahead and move to our case study 1.
Yes, thank you, Fatima. Yeah, look, we've talked about some of the principles of transfer pricing and custom valuation. But what we want to do is we thought we'd run you through a couple of case studies, 3 case studies, in fact, to give you the practicalities and the considerations based on different supply chain activities. So the first case study we're going to talk you through is the impact of year-end adjustments for an Australian distributor who's been buying goods from a related party in India who's a manufacturer. So the group transfer pricing policy report states that the resale margin to be in the range, interquartile range between 8% to 12%, with a median gross margin of 10%. However, at the financial year end, it was determined that the gross margin in Australia was actually 14%. So as a result, it's got some transfer pricing implications here. So Fatima, if this was to happen, how should the arm's length price for compliance purposes be determined from a transfer pricing perspective for the entity in India and for the entity in Australia?
Sure, Richard. Ideally, I'd like to respond to this question in 5 points. The first and foremost being, you mentioned in this case study, between we India and we Australia, the functional profile seems to have changed, resulting in a higher margin. But we don't know. So the first thing I would suggest is that validate the functional profile. What functions and risks are assumed by VPTY Australia? If as a result of the validation, one sees that the functional profile is same as what was expected to be, then one will need to ensure that the result of the transfer pricing policy is in keeping with the policy itself. So if the policy was to ensure 10% profit margin to VPTY Australia, then we group will need to adjust the transfer pricing to ensure that the margin disclosed by VPTY does not exceed 10%. At the year end, V group will also have a further choice to change the policy while still adhering to the arm's length range. Now, the arm's length range mentioned here is the interquartile range. Now, that range is acceptable in Australia. But in India, you will be interested to know, Richard, a modification of the popular interquartile range is followed, referred to as the interpercentile range. And that is between the 35th percentile to the 65th percentile. So I would recommend that we group select a percentage which falls within the narrow margin acceptable to India, in which case the policy can be implemented in a consistent way, which is acceptable by Australia as well as by India. And lastly, assume that the policy is then changed to 11%. V group will need to make an adjustment which ensures that the margin does not exceed 11%, which means 14% minus 11%. The 3% difference will need to be adjusted via a credit note. So in effect, VPTY Australia income will reduce to that extent, and we India's income will increase to that extent. That leads me to the next question, Richard.
Yep.
What will be the implication of this year-end adjustment from a customs perspective, and how should that be handled?
Yeah, thanks, Fatima. Look, there's a couple of implications what you need to consider. So firstly, as I mentioned, post-importation adjustments. Well, firstly, in nearly every country, especially in Australia, there is an obligation to report any post-importation adjustments. So in this case, with the credit note, it's going to actually reduce the customs value. Now, the benefit to a company is if it's reducing the customs value and you've paid duty upon importation, you're likely to going to be incentivized to make the disclosure as soon as possible, for the simple reason is you could be subject to customs duty refunds. So there is a mechanism in Australia called the voluntary disclosure process that allows you to make a disclosure for transfer pricing adjustments or post-importation adjustments in like a safe harbor environment. Basically, you don't get any penalties for adjusting the customs value because it takes them off the risk off the table by making that disclosure. However, whilst you make the disclosure, you've also got to work with another customs department called the valuation department, because what they look at is they'll ask the first question. This is what you need to ask your client is, do you have an existing valuation advice ruling in place with Australian customs? If they do, that makes the disclosure process a bit more simple, because the purpose of valuation advice is that based on your transfer pricing methodology, customs agree that the goods at the time of importation is at arm's length. The related party transaction was not influenced by the related parties. So it's adhering to the arm's length principle. But firstly, it acknowledges that the original import price may be subject to change. And within that change, it could be an agreed margin, i.e. between a range of 8 to 12%. If it falls outside that range, you can apply for what they call a variation to the valuation advice. However, with the credit note, they will validate that they agree with these adjustments. And then what happens is they will then work with the voluntary disclosure team to finalise the disclosure. And if it's a refund amount, say, yes, we'll acquit the voluntary disclosure, but to recover any customs duties, you've got to make additional individual amendments to each transaction impacted by the voluntary disclosure. The next question is you've got to consider, and this is where it's important that you've got robust documentation in place as well in regards to your transfer pricing policy. So when you make a disclosure or you apply for a valuation advice, first and foremost, they'll ask what's your transfer pricing policy. So that's got to be up to date. They'll ask if it's a debit or credit note, they'll ask for evidence of the debit or credit note. They'll actually ask, can you demonstrate the proof of payment through your accounting systems? So this could be an extract of your evidence of payment through your banking statements. If you can't satisfy these requirements, customs could actually reject the voluntary disclosure or ask for further evidence, or for your submission to be reworked. And this flavour continues through case studies 1, 2, and 3. So with that, I think we can go to case study number 2. I think, Fatima.
Sure, Richard. And I think the vital point here is to proactively make the adjustments across transfer pricing and customs so that you can avoid a potential double taxation between customs and income tax itself. So
that's right. But
that.
I think the other takeaway with all this from today as well is, whilst you've got agreed methodologies in place as well, Fatima, it's got to be documented. I think that's the most important thing I would say to anybody.
Sure. Documentation playing a key role. Moving on to case study 2. Very quickly, I'll run through the facts. This case study is designed to highlight the impact of business restructuring in an MNC group, which is operating in the textile industry. So it's the Australian-based company is a limited risk distributor of its Indian parent. The Indian parent sells the apparel to the Australian company in a way that leaves an arm's length limited return for the distribution activity. Now, the Q group is being acquired by another larger apparel group, and a due diligence is undertaken. And when the due diligence is undertaken, it's ascertained that Australian company is indeed performing higher functions and assuming more risk as compared to a limited risk distributor. And therefore, the due diligence ends up recommending that this is a situation which may have a potential transfer pricing exposure from the Australian side. Taking all these findings into account, Q Group has now agreed to revise its transfer pricing model in order to reflect the findings of the, and it would like to revise the price of the goods being sold by it to the Australian company, Richard.
Yeah. Yeah, no, thanks, Fatima. So look, again, this will have customs implications. Very similar to case study number 1. So first and foremost, the original import price was price paid for the goods. So there is no real compliance issues there from a customs perspective. However, if the price is subject to change due to the change of the transfer pricing methodology, as in the case of this case study number 2 here, there is an obligation to report that adjustment and make a relevant disclosure through the various channels I talked about in case study number 1. To probably the valuation team, you need to go first and foremost. And again, it will be a detailed submission stating the facts of how the adjustments occurred, provide the supporting transfer pricing documentation, any subsequent paperwork, especially if it's going to impact the COGS of the goods sold or imported. And you're going to need to pack it up with customs. So the valuation approval team will give you the tick of approval. Also, then you need to then make the obvious disclosure to the customs section. But moving forward, to safeguard you going forward and de-risk this for future importations as well, I would recommend, in the absence of a valuation advice, a valuation ruling, which you can apply with most customs jurisdiction, I would actually go and apply for one, because what it does, it takes any risk going forward off the table, and you just demonstrate the right corporate behaviours for the customs authorities, especially if it's got duty and GST purposes. But again, to do all this type of stuff, it's got to be supported by documentation, and that's all what customs typically look for. Yeah.
Absolutely, Richard. And I think that is a great segue into question number 1, which is what are the transfer pricing considerations coming out of this policy reset that Q Group is contemplating, and what would be some of our recommendations here? The first thing, again, I would say, do a comprehensive validation of the functional profile and risk assumed by the Australian company. And this can be done in a conversation with the operational heads in Australia, with also including the operational heads based in the parent company and any other company which is engaging with the Australian company relevant to the related party transactions. So that would be step number 1. Step number 2 would be that it's now clear that the previous benchmarking no longer serves the purpose of the current business facts as coming out from the due diligence. Therefore, a new benchmarking needs to be undertaken, based on which the arm's length price can be determined. In other words, Richard, the valuation that you referred to, the transfer pricing documentation and a refreshed benchmarking analysis can go a long way in supporting the value for customs purposes as well. And the next point would be for the Q Group to select a midpoint, if it's a profit-based method, within the interquartile and interpercentile range, such that the percentage meets both India as well as Australia requirements. Lastly, update the transfer pricing policy documents going forward, including the intercompany agreement, and then start the invoicing based on the new transfer pricing policy. Of course, the documentation needs to be built thoroughly to cover the new functional profile, benchmarking analysis, and also the new TP policy. And that would be some of the highlights from a transfer pricing, and also, go a long way in supporting the customs valuation here. Right. Richard, let's then move on to our case study number 3.
Yeah, thanks, Fatima. And look, this is the final case study we want to run through, and this is high-level overview of case study number 3. It's the impact of a transfer pricing adjustment in a manufacturing company in India that was upheld by the courts in India. So under this case study here, Z India imports boilers from its parent entity, Z Australia, which is used by Z India for producing steam to generate electricity, which is further used by to manufacture steel. India imports similar boilers from independent suppliers and applied the cup method in its TP documentation for ALP valuation. Similarly, from a customer valuation purposes, Z India accepted a transactional value method using the same comparable data. During the TP assessment procedures, the TP officer rejected the use of the cup method and applied the transactional net margin method for ALP valuation and made the upward adjustment to Z India's taxable income. This adjustment was also upheld by the higher courts. So Fatima, in this scenario, what is the transfer pricing implications of the adjustment for the entities, and any suggestions on planning the policy better?
Sure. Richard, it's clear that Z India and the Z Group have used a common method for benchmarking the valuation for customs as well as transfer pricing purposes. Now, in ordinary circumstances, you would say that's the right thing to do, use the same method for the same transaction, and we should be good. But like we had mentioned at the start of the webinar, because of the different intents of the two regulations, the authorities are free to choose a method that serves the purpose of that regulation better. And that is why the cup method seems to have been rejected by the income tax authorities. And one of the reasons there is that the level of comparability that income tax authorities expect while using an independent reference of price is very high. So boilers as a commodity, as their inherent nature is they are very technically different. Each boiler is technically very different depending on the usage, right? And every minor difference in the overall make of the boiler can have a big impact on the pricing, Richard. So income tax authorities typically look at the level of comparability. If that is not explained by the company well, then the fallback method is the TNMM, and that is what leads at times to adjustments because the company is not well prepared to defend it. Because explaining the net margin is a result of a variety of business and economic circumstances. It's not always controlled by the pricing in international transactions, correct?
Yeah.
So that is one area I would suggest, that choose a method that takes into account your business and economic circumstances, and also this inclination of tax authorities to use these different methods when they come in for an audit. That is very important. So Richard, having explained that part, I would want to come back to this very interesting and important implication for Z Group. All said and done, they have received a big adjustment, which has also been upheld in higher courts. So is there any way of for the company to take a benefit in a way, reducing their customs prices declared? Because one way they have ended up paying customs duty at a higher price, but income tax authorities have not accepted. Although they have adjusted the income, Richard, effectively it ends up as a reduction of transfer prices, which perhaps one cannot go back and revise your financial statements, which are long closed, right? And these things can take up to 7 to 8 years. Sorry about that, Richard. Over to you.
No, that's okay. Look, it's an interesting scenario, is this, because first and foremost, there's a couple of observations here, but I'll talk about the income tax adjustment. Customs are only interested if that adjustment is made to the cost of goods imported, right? So that's one thing you need to consider with this case study here. Secondly, for that adjustment to be accepted, even if they made it against COGS, if it was just a token journal entry in an accounting ledger and it wasn't an actual genuine transaction, i.e. the credit note or debit note wasn't actually paid through the banking records, that adjustment could be rejected by customs anyway. because they always ask for evidence of payment, which makes sense. So that's a couple of things to consider with this particular scenario here from Fatima, which is unbelievable, really, because you would have thought they would want to maybe capture some additional revenue in some instances. The other points to consider, and I found really interesting with this case here, is although you've got two different supply chain flows from related parties, non-related parties, right? As they explain in the principles of valuing goods from a customer's perspective, you've got to take a hierarchical approach. And I assume with both of these transactions, and that actually at the time of export, did a sales transaction take place? Now, with a non-related party transaction, unless you were using the DDP Incoterm, yes, it would. A sale transaction would take place. So therefore, you'd use method one, the transactional value. Likewise, if it's a related party transaction, typically you'd use, there would be an evidence of a sale, unless it's the Incoterm or was just being treated as a stock transfer. So that, again, method one would apply. So that would be the transactional value, price paid for the goods, and that price paid for the goods would be dependent on your transfer pricing policy. And actually, one thing what I didn't talk about as well, under your transfer pricing policy, if you've got a potential markup, say between 5 or 10% on your cost of goods, it's got to factor in that transfer pricing markup as well. That's really important. I've just been assisting a client where under their transfer pricing, they've got robust documentation in place, but for the related party transaction, there wasn't including the transfer pricing markup for customs purposes. So essentially, they've been undervaluing the goods by, I think, between 5 or 10% for the last 4-year period. So that's a couple of considerations about the supply chain transactions, about the adjustment to COGS. How can you get around these issues first and foremost? I think from a customs perspective, you just got to follow what your transfer pricing documentation says for your related party transactions in particular. You declare the price paid for the goods. Now, if that results in post-importation adjustments because it's transactional net margin method, you're going to have to potentially go through that disclosure process if there was adjustments made to COGS. I think that's the most robust policy you could probably follow. You can plan better, I suspect. It's not ad hoc. You can get consistency with how you value your goods, because typically you don't change your transfer pricing every year. It's probably only looked at every 3 or 4 years. So you get consistency with how you're valuing goods from a transfer pricing perspective, but also from a customs valuation perspective as well. I think that's a couple of my considerations.
Thank you, Richard. And I think that's a great segue into our next slide, which is in effect a summary of all of the conversations we've been having in this webinar, both from transfer pricing as well as customs perspective. One is to plan ahead when before you're trying to start a transaction with a group company. Around the same time, the first thing is the entry strategy or the choice of entity. But at the same time, I would highly recommend that the transfer pricing as well as the customs is planned hand in hand, so that you are able to anticipate and mitigate any kind of risks that may arise later by different tax authorities looking at the value, applying different methods. So planning at the earliest and well ahead, and also planning transfer pricing and customs at the same time would go a long way in helping you plan ahead. Moving on to the documentation part, as Richard has been mentioning throughout, and like I've also mentioned, it is really your key to demonstrating arm's length. All of what you do needs to come into the documentation, and most countries, including India and Australia, for transfer pricing purposes, have a 3-tier documentation prescribed, which is a local file covering your local operations in each country. There's a master file which covers your global operations to a level of detail, like common transfer pricing policies, description of your services, goods, intangible, the business strategy, etc. And then if your business is of scale, there is also a country by country report to be submitted. But by far, transfer pricing is a regulation which insists and prescribes detailed documentation, which you can use for customs purposes as well. And finally, uh, we would highly recommend that the policies be reviewed, because business is dynamic, but so are laws, and they keep changing based on what tax authorities are seeing and how business is evolving as well. So at the very least, I would recommend that the policy be reviewed on an annual basis, and this can in a sense help you optimize your taxes and your pricing that you are fixing in intercompany transaction as well. And before we end our presentation, I'd like to touch upon a few important aspects which businesses are also expecting from policymakers. And this was also highlighted by the World Customs Organization when they convened and published a white paper making several recommendations to governments of different countries. The first and foremost is documentation. How do you consolidate and have a documentation which can serve the purposes of both transfer pricing as well as customs? Second, again, is valuation. How can governments enable the tax authorities to use similar valuation methods, or at least valuation which is accepted by customs, say, be acceptable to transfer pricing authorities, and vice versa? The next one being timing. Like I mentioned, customs is the first port of call, and that's the valuation which is typically done first. Transfer pricing kicks in as towards the year end very often, but I see a lot of companies doing it on a proactive basis as well. But enabling a common timing through legislation as well as administrative reviews is another thing which governments can look at. Dispute resolution really forms the key to enable ease of doing business as well. And like income tax has advanced pricing agreement mechanism, the customs authorities can also start looking at similar avenues to agree on a pricing beforehand rather than debating. And I can share that customs regulations in India have been loosened up over the years, and they have moved from a compulsory audit to a more self-governed valuation disclosure basis. And finally, what would be great is if there's a common team administering transfer pricing as well as customs, but it'll need coming together of both the legislations and further capacity building, enabling similar of the same officer set to have skill sets to implement both the regulations. So all in all, these are the points we had, and we hope you found it useful. Jason, over to you for the Q&A section.
Okay, if I can encourage anyone to, if they have any questions, please send them through. We do have a couple of questions here. Richard, a couple of questions for you, and it's really around royalties and how royalties are considered in the customs value, and in particular, when the royalty isn't known at the time of import, so when the royalty is determined post-import based on potentially the performance of the company or some other metric. How is that considered in the customs value? What's best practice?
Yeah, Jason, that's a really good question. Look, I think as I said about when we was talking on the slides, it's a case of reviewing the agreement and see if it's a condition of sale. If it can be determined if it's a condition of sale, that the royalty payments will be payable. I think that's one of the first things you need to always consider. If it's a condition of sale that you can't purchase these goods without triggering a royalty or license fee payment, yes, that would need to be disclosed post-importation. The other second consideration now, in some countries, if we can break the nexus of the royalty payment to the actual original import transaction, it could be treated as a non-dutiable item as well. If you can determine that it's not forming part of the price paid for the goods, and again, that's reviewing the agreement, there is ways and means of being able to exclude royalty payments as a dutiable component, especially in Australia. In some countries, a royalty payment is just treated as a dutiable item.
Fantastic. Thank you very much for that, Richard. I think we've come to the end of our webinar. There are a couple of other questions that unfortunately we're not going to quite get to today, but we will try and follow up with those people to provide a response to their questions. We would really like to thank everybody for taking the time out of their busy day to join us today and to listen to, I think, a fantastic webinar. I'd like to thank Richard and Fatima for their participation today, as well as their really interesting comments that have been made throughout the presentation. Please join us. As I said, this is going to be a regular webinar series that we are going to run every second month. So the next webinar will be on the 25th of July. The topic for that webinar will be transfer pricing audit trends in Australia, China, and Japan. So I think that'll be a fascinating topic. So please join us if possible. But really would like to thank everybody for their attendance today, and I hope that you enjoyed it as much as I did.
Thank you, Jason. Thank you, everybody, and the entire team that helped us conduct this webinar. Thank you, everyone, for attending.
Thank you.